things that I'm sure that you've seen informally, that if you look at it a particular way, you see a certain thing, and then if you focus on another part of the painting, you see something different. And I think you've probably all seen them, right? One of them, for example, was the hourglass. You look at it, it's an hourglass, but if you look at it a different way, just a slightly different way, it's two faces seeing each other. Or the one that I know got around on fax is you look at it the one way and it's the beautiful young woman. You look at it a different way, it's the old hag, right? You know, like that. Or the other one that was there is it's a bunch of geese flying, and if you focus on a particular dot, the geese are flying this way, and if you focus on another dot, all of the geese are flying the other way. Now notice what's happened. The painting hasn't changed. Your perception has changed based on what you focused on. Therefore, the process of dealing with objections is not to overcome the objection. The process is to reframe the perception. So when you're dealing with objections, you reframe perceptions of that objection in a way that what? It spins it around so that it doesn't exist anymore. And now that obstacle isn't there. Why? Because it wasn't there, it was there, it doesn't matter. The perception makes it not there anymore. That's where I need to focus my attention. So when I talk about objections, I don't talk about overcoming. What I talk about is neutralizing objections. You take out that Star Wars gun, right, and you zap that thing away so that it doesn't exist anymore. It ionizes, right? It gets out of there. It's no longer any reality because the perception has changed. And the way that you neutralize objections is by reframing. Reframing the other person's perception of it. Now, how do you do that? How's the language of it? Let me give you an illustration. So I've got Yvonne. I've made her a $71,000 offer for an $81,000 note. And so she says to me, in relationship, by the way, because remember, we've developed relationship here. So in relationship, she says, Larry, I know that you think this is the best thing for me, but I mean, that's a $10,000 loss. It's an $81,000 note balance, and you're only offering me $71,000 for this thing. Now, I'm in script. I'm in response now, responding to the specific objection. Number one, how does it sound? Number one, I say, Yvonne, I certainly understand why you think that. So what do I start off with? Affirmation. Number one, affirmation. Number two is validation. I certainly understand why you think that. So many people do. Validation. I've now allowed her an opportunity to know that she's in the majority. Validation of her opinion. So many people think, now what am I going to do? I'm now going to create the agenda. I'm now going to summarize her position. So many people think that when you sell a note for less than the balance of the note, you're actually losing $10,000. What have I just done? I've summarized her position. So it's affirmation, validation, summary of the other person's perception. Now, right, may I put a different spin on it, if I may? So it's, Yvonne, I certainly understand the way you why you think that. So many people do. So many people think that when you sell a $71,000 note for $81,000, they're actually losing the $10,000. Could I put a different spin on it, Yvonne? Supposing the day that you sold your house to Donna for $125,000, and you took $25,000 down and a note for $100,000 payable over 20 years. Remember the day you signed that contract? What if that same day I had knocked on your door and I had said, Yvonne, I'd like to buy your house too. And I know that you're about to sell the house to Donna for $125,000, 25 down, and $100,000 over a 20-year period of time. And I said, however, I'm not prepared to pay $125,000. On the other hand, I am prepared to pay in cash. I've got a checkbook in my left hand, and I have a pen in my right hand. And I will cut you a check right now, not for $125,000, but I will cut a check for $115,000 in cash. Now, simple question, Yvonne. Would you have accepted Donna's offer of $125,000, 25 down, and $100,000 over 20 years? Or would you have accepted my offer for $115,000 in cash? Now, if Yvonne has red blood flowing through her veins, if she is a mammal on the planet Earth, she's going to say what every one of you would have said, which is $115,000 in cash, right? At which point, what I will say is, Yvonne, what I want you to know is you now have a second chance to make that same decision. It's over. It's over. See, I haven't had to overcome the time value of money objection because what I've done is I have reframed her. Where did the reframing occur? I have reframed her from thinking that this was the discount of a note that nobody's prepared to do to the discount of a real estate transaction for cash that everybody's prepared to do. See, once she got reminded that the reason she had this note is not because it was a $100,000 loan, but because it was an exchange for the real estate that she once owned, her perception has now shifted to the point that its obstacle doesn't exist at all. What's more, now that her perception has changed, she's now given herself intellectual permission to accept. In addition, even more, what she's now done is this now becomes hers. So at this point, when she's challenged by her husband, who says, you accepted that guy's offer? We're going to lose $10,000? She says, no, honey. What if he had been here when we first, right? It's now hers. It's now hers, right? See, that's what we're trying to achieve. Factoring, by the way, it works no different than that. Factoring, what's the primary price component? Primary objection to factoring, by the way, most of the time is price. 5% a month? 5% a month, Larry? You're trying to tell me 5% a month? Good grief, I can borrow money from the bank at what? 11%, 12%, 14%? 5% a month, that's 60% a year. Are you really believe that's in my best interest? Yvonne, I certainly understand why you think that. So many people do. So many people think when they hear about a factoring transaction that a factoring fee is the same as interest on a loan. I've summarized her position. May I put a different spin on it, though? Now, you know, and what you told me the other day is you give payment terms, right, of net 30 days to the customers who buy from you, and if they pay in 10 days, you'll give them a 2% discount, right? Well, let me just ask you a simple question. If they were to pay you in 24 hours, would you be willing to give them a 5% discount? In other words, what are you saying? Are you saying, Larry, that real simple. If they come to you and they say, I'd like to buy all of this, and I'll pay you tomorrow, would you give them a 5% discount? Of course you would. Any business person would. I want you to know that when you factor, that's exactly what you're doing. When you factor, you're doing nothing more than giving a prompt payment discount. The only difference is you're not giving a prompt payment discount to your customer. You're giving it to a third party, which we happen to call a factor. It's exactly the same thing. Where's the reframing occur? Where the reframing has occurred is that as long as she sees it as interest on a loan, her benchmark is going to be 11, 12, 13, 14%. When she sees it as a prompt payment discount, her benchmark is going to be what would she give to somebody to pay in cash? That discount is what's going to be an acceptable one for her to have intellectual permission to accept the offer. See, we had a sporting goods. My dad and I had a sporting goods business together, right? We used to sell sporting goods to athletic departments, recreation departments, school boards, and so forth. Occasionally, when a retailer would come in and buy basketballs, we had a warehouse, buy basketballs from us in bulk, we would bill them net 30 days to the retailer. But I'll guarantee you, when somebody came in with their checkbook, and they're prepared to pay right then for whatever they wanted to put in the truck, you don't think I'd give them a discount? Any business person would. See, if they see it as a prompt payment discount, their perception changes so that it no longer becomes an objection, it no longer becomes an obstacle. See, the objective that you've got when we're dealing with these things is real simple. First, I need that complete informational transfer. I need to understand what the objections are going to be so that I can script powerful responses to allow me to, what? Reframe the objections in a way where the perception no longer sees it as an objection. Now what do? Now what happens is, we started off with this obstacle between us. I have not moved one bit. The only thing that I've done is I've just simply neutralized it. It no longer exists. Now what do we have? We now have free airspace between us. But the fact is, Yvonne is still there, and I'm still here. So what do I now need to do? What I now need to do, we no longer have the obstacle, so what I have to do is now pull her forward. I now have to pull her toward the intended solution. How do we do that? By reminding her of the benefits to be achieved. I have to refocus her on the benefit to be achieved. See, now that we no longer have a listening, now that this obstacle is gone, now I can move forward with the benefit. Otherwise, what happens is, how can I deal with the benefit? That, by the way, is objection stuff, overcoming objections. Yes, but, for typical sales language, yes, but, Larry, think what you can do with the money. But the problem is I haven't changed the perception. So I have this great big listening in my mind. So I can't go forward because it's an obstacle to me getting to understand what you're doing. Now that I've eliminated it, now I can move forward. Now I can go forward with the transaction, with the intended solution. So I refocus you on the benefit to be achieved. What does that benefit to be achieved now mean? What does it say? It says, now, you know what, Yvonne? But you know, this really isn't about buying or reselling your real estate. You already sold your real estate. The reason I wanted you to understand that is because that's all you're doing. It's the same as if you had sold your real estate for $115,000 in cash. But this transaction and this conversation isn't about that, is it? What it's really about is making sure that you have the cash to send your daughter to that expensive Ivy League school she wants to go to. Your mortgage can't do that. My cash can. I'm refocusing her on the benefit to be achieved. But you know, Yvonne, this isn't really about offering prompt payment discounts, is it? I just wanted you to understand that that's all factoring is the offering of prompt payment discounts to a third party. But what we're really talking about is not that, are we? What we're really talking about is making sure that you have so trapped and enwrapped the athletic distribution business in San Diego that you'll never have to worry about competitors coming in. A bank loan can't do that, can it? My factoring can. See, how did I know what the benefit was? Because I make it my business to find out what the benefit is. See, when I said informational transfer, the reason I need that is because I've got to arm myself with the ability to deal with any of those objections and to refocus. And when I refocus them on the benefit, what am I doing now? I'm saying obstacle is gone. Come on. Now here's your passion for movement. Come on, let's go. Here's the intended action. Should we go ahead and get started? So now I'm prepared to move forward because she understands the benefit to be achieved and she doesn't have any prior listening against it. I eliminate the objection, you refocus on the benefit. Now, understand this. This is by far, in terms of conversion, the most powerful formula you will ever learn as far as conversion. Whether I'm arguing to a judge or I'm arguing to a jury or I'm one-on-one in a persuasion issue, this is the essence of influence and persuasion, what you've just learned. The difference, however, between a fraud and somebody who does it with integrity is the next point that I want to make to you. The next point is, this is technique. Technique is powerful, technique in and of itself. But what makes this not only more powerful, but also substantiated by integrity is this point. You've got to be solutions dominated. You have to be solutions dominated. See, when it comes right down to it, I want to be able to speak with the power of conviction. This is the best thing for you, Yvonne. I believe it to be the best thing. See, understand what the whole conversion process has entailed. The whole conversion process entails me holding myself up there and putting myself on the line. And I'm saying, this proposal, Yvonne, is the best thing for you. And I'm prepared to stick my neck out there and tell you that. It's got to be based on my commitment to being solutions dominated. I have got to come up with that powerful formula that will assist you in your business. So solutions dominated basically means that as a professional, you're not in this business, you're not a retailer, you're a tailor. You're not a retailer, you're a tailor. What does a retailer do? Retailer basically says, Yvonne, what are you looking for? Great. Off-the-shelf stuff, right? Do you like this? Do you like this? Do you like this? That's what a retailer does. Tries to match your need to what I've got in inventory. That's a retailer. What a tailor says is, let me measure you up. Okay? Get all the measurements. What do you like? What are you looking for? What kind of suit? You want a real business look? You want a different type? Great. Tell you what, come back tomorrow. And in the meantime, I'm in the back room, and I'm cutting, and I'm sewing. And I now come up with this suit, which is cut to order. What do we call that in this business? Structuring transactions. Structuring transactions. Why I want you to understand how to structure transactions is because I want you to understand how to cut a pattern for a particular client under a particular circumstance and a particular need. That's being solutions dominated. Then when I look at it and she says the lapels are a little big, and I say, no problem, we can handle that, man. Snip, snip. How about it? She says, I like it. Can I get it in navy? You bet. I'm solutions dominated. I'm structuring the transaction. When I'm dealing with Yvonne, who is 30 years old and who's trying to sell a note, that's one thing. And she's trying to get as much cash as she can. And I'm going to structure the offer in exactly that way. When Yvonne is 78 years old and has a 15-year note, and it's payable over a 15-year period of time, what will happen is she's not going to want as much money as she wants. What she really has a problem with is the fact that she has $500 a month coming in, and she has $2,000 a month going out. She doesn't want it over a 15-year period of time. What she wants is maximum amount income over a 7-year period of time. So she will trade that note gladly for a funding source that will put $2,000 in for the entire note so that she can make the payments. So it's $500 a month that she's receiving in exchange for a funding source paying $2,000 a month on that particular mortgage. It's a completely different transaction. In factoring, when she comes up and I say, you know what, I studied your aging, and it seems to me that your receivables are basically paying most of the time on a 13-day basis. 13 days are your average receivable cycle. And if I give you this particular factor, it's a good factor. They've got plenty of money, but you know what? They're going to charge 2% if they get paid within 10 days. But they're going to charge 5% for anything that they get paid on after that 10th day. On the other hand, this other factor is much smaller. We're probably going to have to watch how much funding they've got, but they're willing to do the following. They will extend that 2% to the 15th day, and then it's 5% after the 15th day. If you use this factor over here, you'll only be paying 2% for the majority of your receivables, whereas this one over here is going to charge you 5%. Structuring transactions. When you're a professional in this business, you are solutions dominated, and you want to make sure you bring to the table solutions that you can believe in. And I say that because there's nothing wrong, by the way, with influence. There's nothing wrong with persuasion as long as you do it with integrity. And the way that you handle the integrity is by absolutely believing what you say is the right thing for the other person in that transaction. You know, it's interesting. I wrote probably about 6 months ago, I wrote an article for the American Cash Flow Journal on the Three Tenors. You know the Three Tenors? And they did that CD. And I was up in a hotel room someplace, and I was ironing my shirt. And I'm listening to, before I came down, you know, kind of similar. And so I'm listening to one of the tenors, whichever one was doing this, the song, which was My Way. Remember My Way, Frank Sinatra? And I'm listening to this song, and of course, he's got a beautiful voice. I mean, tenor, I mean, you know, metropolitan tenor. He's got a beautiful voice. And I'm listening to it, and it was incredibly technically competent. You know what? From informational transfer to refocus on the benefit, it was technically competent. But what it was lacking was what Frank Sinatra brings to the table. The passion of conviction. See, when Frank Sinatra sings that song, now Frank Sinatra's voice is hardly technically competent, right? Nobody ever accused him of having a technically competent voice. But when he sings My Way, he's singing his story. It's his story. It was written for him. He delivers it with a passion of conviction. That's what I'm talking about. See, you can be very, very successful with technique, but you can be unbelievably powerful in conversion when you back it up with the conviction and the belief and the passion that goes behind it. And I just want to suggest to you that when you bring to the table a solutions-dominated mentality, what you do is you give yourself the opportunity to absolutely believe that what you're saying is in the best interest of the other person in this transaction. And what that does, more often than not, is just simply create higher effectiveness in all of the conversion mentality that you've created and the relationship that you've developed with the person that you're dealing with. Now, how does that all boil down? It boils down to a conversion plan. And it's just like a marketing plan. Because what you will do is with that, you'll then develop a conversion plan that will have the exact components that I just discussed. In other words, once you've selected out your niche, what you're going to do is you're going, because you've already done that, right? You've established what your niche will be, so you have to have the informational foundation. Number two, you're going to actually list out, oh, by the way, the informational foundation is going to be whatever worksheet you develop with your client or prospect. Number two, you also want to come up with what the objections are. And the objections will be depending upon the particular niche that you create. If it's factoring, it's going to be the following. If it's boat notes, it's going to be the following. So you come up with those typical types of objections. Number three, script your responses. Number 4, list out the primary benefits. And finally, number 5, itemize out the particular solutions that you're going to be bringing to the table. Now, what I'm suggesting is that within the context of an entire business operation, the marketing plan becomes literally the organizational, operational structure that you're going to use for marketing. In the conversion plan, you're going to be directing it not only in general terms, but also to a specific prospect that you've brought to the table, so that you allow yourself a worksheet, but you also allow yourself to analyze the primary benefits to that person, and in addition to that, the opportunity to bring solutions to the table. Now, that's the process. Let's review real quickly before we actually take a break. What's happened in all of this that we've discussed is we've been talking about a procedure whereby what? I want to use a formula that allows me to be extremely efficient. And you know, it's kind of like in the marketing side, we talk about the first core process, which is marketing. I start off with, anybody shoot darts? You shoot darts? How do you shoot darts? How do you teach yourself how to shoot darts? Get real close. You get real close, right? You get right up to the target, man. You get right up to that target. It's like right there, 2 inches away. Doom, 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 doom. Then you what? Doom, 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 doom. Get it down, right? See, that's what I want you to do. When it comes to marketing, I want you to get right up there to your target, because you need to have the immediacy of being right up against your target all the time when it comes to marketing. You know, at Notre Dame, I was in the fencing team. Obviously, like Notre Dame, I wasn't on the football team. So, you know, and so we talked, in order to teach you how to fence, what they do is they give you a foil. And you walk around campus with this foil for months. I mean, it goes around everywhere with you. I mean, it's like you walk around, you take it to the dining hall, you take it to the shower, you walk everywhere with this foil. Now, the objective, by the way, is to make sure that by the time you're finished, this foil is an extension of your arm. And you need to just simply know that all the time. You know exactly where this thing is pointed and so forth. The only way to do that is just walk around with it. When you finally kind of get the idea of what this thing is, they then don't allow you to fence, by the way. You then get to poke at a tennis ball. So what happens is they have tennis balls strung from the ceiling. And what you do is you get up real close to the tennis ball, right, 2 inches away, and just simply go boom, 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 until you get real good at that several days later. And then you back up a couple inches. Then you do boom, boom, right? Then you back up a little more, and you then start to lunge a little bit, right? Boom, boom. When you get real good at that, they start moving the ball. And then you have to keep lunging. And finally, after about 4 months of all of that, they'll finally let you fence a live body. Now, that's the way that they teach you how to fence. See, marketing is no different than that. Marketing, what you want to do is you want to get directly up to your target all the time. It's kind of like, you know, right up to the wall. It's a baseball. It's a tennis ball. Boom, 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 like that, so that it comes right back to you all the time. The process that you've learned from a marketing formula is a process that makes that extremely efficient. Why? Because I suggested to you at the break that I know you will and can be successful, but what I need to make sure of is that you'll be successful before your grace period wears out. And for each of you, you've got a grace period that can wear out. 6 months later of going down the hole with no cheese, many of you are going to be saying, I think that I don't want to be going down these holes anymore. And I'm going to suggest to you that it's not the business that's at issue, it's the formula that you've used to go get those holes. Allow yourself to develop a very specific marketing formula. You understand what that looks like. Number two, what you then want to do is to allow yourself to maximize your effectiveness. And the way that you maximize your effectiveness is the marketing formula combined with a conversion formula, so that you understand exactly what you need to be doing and exactly what you need to be saying. Now, in the process, what do you end up with? Efficiency in marketing and effectiveness in conversion. So far, what we've done in discussing this is we've talked about the core processes. We're focusing on the 3 core processes. We've understood how to develop a marketing plan that efficiently brings prospects to the table. We then took that prospect and we developed a conversion plan so that you're effective in the process of converting. Third and one final thing to do, right? The third process is the funding process, whereby we're going to be bringing capital to the table. So let's go ahead and focus on that at this point. Let's talk about the funding process. In the process of funding, just like with everything else, once again, we start talking about it in terms of an attitude. We have the marketing mindset. We have the conversion mentality. When it comes to funding, your attitude is that of being a professional, and it's a professional demeanor. That's what you're trying to accomplish in terms of the funding component. When it comes to funding, what are you trying to do? What you're trying to do is bring capital to the table so that no matter what kind of deal you bring, you've always got capital available for it. That's really what you're talking about here. So what is it that provokes that? What is it that brings capital to the table? Well, what does, of course, is a professional demeanor on your part, an attitude of operating as a professional. Recognize, and the funding sources do, that you're coming into this business with zero experience. They assume that. We assume that. So they're not looking for somebody who necessarily has a bunch of experience. If you do, great, but if you don't, it doesn't matter. But they are looking for somebody who's going to come in with a demeanor of a professional, somebody who operates as a professional, even though you may have no experience and a bunch of book knowledge, learning in the course of 5 days of classroom training, but at the same time, what you want to be doing is conveying to them that you're a player, you're a professional, you're not a flake. And that's what I'm talking about. It's the attitude of a professional, it's the attitude and the demeanor of somebody who's operating as a pro in this business. What does that sound like, and what does that look like? There are some components to a professional demeanor. The first, and I'll kind of basically talk about all of them at the same time. You've got your accuracy. A professional is accurate. Somebody who conveys information accurately to somebody else is somebody who goes out there and finds out the information and conveys that in an appropriate way. Secondly, you're thorough. You're not just simply giving them a little bit of information. Tell me a little bit about the house. Well, it's a residential home. Okay. It's owner-occupied. Okay. What else? That's about it. How many bedrooms? Gee, I don't know. How many baths? Gee, I don't know. It's kind of like the conversation with the fellow from the funeral service parlors, where he's talking about in Nashville. I mean, everything is, I don't know, I don't know. That's not the mark of a professional. The issue is not that he's never had any experience in closing a deal. The issue is, with that type of attitude, how could he ever expect to get any type of funding? He certainly didn't get conversions, but he's also not going to get any funding too. So you want to be accurate, you want to be professional, you want to be thorough, and you also want to be reliable. A funding source is a reliable funding source. And working with a funding source, a broker has to be reliable. What does that mean? That means if you say that you're going to FedEx, FedEx. Don't just simply put it in the mail. They're looking for a FedEx and you stuck it in the mail. If you say that you're going to call somebody at 4 o'clock in the afternoon, call them at 4 o'clock in the afternoon. If you say that you're going to send certain documents, send the documents that you say. Do what you say. And by allowing yourself to do what you say you're going to do, what you do is you create an expectation on their part, and you also create an understanding that they're dealing with a pro. That's what I'm talking about. So don't worry about your lack of experience. Don't worry about any of that component. That's an assumed. And you have to start somewhere. I mean, before you do your second deal, you've got to do your first. And before you do 100 deals, you have to do your first. So everybody understands that you've got to do your first. But what I don't understand is what I call the acceptable level of casualty. A broker who is operating as if, and with that cavalier mentality, that would suggest that you're taking everybody for granted, including the funding source. If you take a funding source for granted and don't operate with a funding source with the type of respect they deserve, then you won't have a funding source. It's just that simple. So allow yourself to be a professional in terms of your demeanor. Now, once you've got that, and once you allow yourself that type of demeanor, what do you now want to do? We talked about definition of funding. Not real easy. Definition of funding is pretty obvious, right? It's funding. It's show me the money. That's ultimately what you're doing. So we don't need to be concerned about more than that. What's the standard that you want? Sufficiency, adequacy, allowing yourself the opportunity to have the amount of money you need for any type of transaction that you do. Now, in order to achieve that, just like there's a marketing formula, just like there's a conversion formula, there's also a funding formula. So what does that funding formula look like? The first of the funding formula is, let's profile. Let's allow ourselves to profile, because the profile of the funding source will allow you to bring to the table the type of funding source who wants to do that particular type of transaction. So, you know, if you have an aircraft deal, and it's a particular type, it's a Piper, it's a Comanche, it's some type of twin engine, you bring it to the right type of funding source who buys that. Somebody who's buying a boat note does not necessarily mean they're going to buy an aircraft note. Somebody who's buying a piece of real estate or a real estate note doesn't mean they're necessarily going to buy an annuity. So you need to profile the particular funding source that you're bringing to the table. In a sense, you know what it is? It's prospecting, but it's prospecting in the reverse direction. You're prospecting to the funding source. The only difference is, of course, that in this case, we've got the funding sources. You already have them identified, and you even more so have the actual buying parameters on that sheet of paper. So it's not like you have to go out there and look for them. They're there. That's all you need to do is apply it. So if I'm going to be going in a particular direction, and I know that my niche is going to be whatever, factoring for construction receivables, who I want to be doing in producing as a funding source are those factors that factor construction receivables. So I would be profiling that particular thing. So you profile it on the basis of two things. Number one, on the basis of the debt instrument that they're going after, and number two, on the basis of the buying parameters. Because even though they might have that particular type of debt instrument does not mean that their buying parameters are the same. Metropolitan will buy both notes secured by residential real estate as well as commercial real estate. The associates only buys residential real estate notes. So to send a commercial deal to the associates, they're going to look at that and say, why are you sending me this? Because it's not in our buying parameters, and our buying parameters are published in the directory that you're actually getting. So start off by profiling. Now what does that do? It creates efficiency. It creates efficiency because when I'm dealing with a profile of a funding source that wants that type of deal, for one thing, I've eliminated all the rest of the funding sources that don't want that type of deal. So I'm now dealing with just the ones that I'm going to be focused on. The second thing it also does is it allows you an opportunity to bring the deal to the right type of funding source that's going to be motivated to buy it. If a funding source is not motivated to buy it because it doesn't fall within their buying parameters, they're not going to be working real hard to get that deal. You know, somebody brings me a deal. As a matter of fact, I had somebody discuss a deal with me at the break about a deal that falls outside of my buying parameters. I'm going to take a look at it because in any event, number one, you're a graduate, you're my student, so I want to take a look at it. But if I were just out there as a third-party funding source, number two, I'm probably not going to be a whole lot interested in something that doesn't fall within my buying parameters. See, why do they have buying parameters to start with? Because they've got capital, and their core process is different than yours. Their core process, one of the core processes for a funding source, is that they have expertise in the evaluation criteria and the process for buying that particular type of debt instrument. So because they do, one particular funding source might have expertise in knowing the difference between a note secured by a Cessna and a note secured by a Piper if they're dealing with aircraft. But if they're not dealing with aircraft, they have no idea of the difference between the two in terms of the resale value of those two types of aircraft. So their underlying parameters for evaluation and underwriting, part of their core process as a funding source, are outside their area of expertise if another type of debt instrument is presented to them. In addition, the very closing process, which is also a core process for a funding source, the closing of that particular transaction, is very different for an aircraft note than it is for a piece of real estate. So if they don't have expertise in that particular process, that's not something they're going to want to do. So they might have a wad of cash in the bank, but it's just not something that they're going to want to use their wad of cash for. So the first of the formula, if you will, as far as funding, is let's go ahead and profile the funding source that you're with. Number two, a complete informational transfer. Remember that they want to know everything that you know, because the more they know about what you know, the better they're going to be able to help you serve your client or your customer. So once I get this information from Yvonne, I want to be transferring this information to the funding source that I'm going to use, because as they're now working with me as a partner, I want to arm them with the information that will help them structure a deal that will make my conversion process easier. Because remember, sooner or later, I've got to come to the table, and I've got to come to the table with a structure. And if you remember what I suggested earlier before the break, be solutions dominated, well, your ability to be solutions dominated is directly dependent on the funding source that you use having solutions to the particular situation that you're in. So you be solutions dominated, but complete informational transfer to the funding source so that together, Yvonne, funding source, and we can work together to satisfy my client's needs. So number two, it's a complete informational transfer on their part. Number three, let's always work with a personal cover letter and a worksheet. Personal cover letter and a worksheet. I've given you, and in the manual, of course, what you've got is you have those informational checklists that provide all of the stuff that you're supposed to be writing down and transferring depending upon the type of income stream that you're working with. At the same time, what that does not give you is any type of backdrop. See, when I receive that type of backdrop as a funding source, for example, my company, International Funding Corp., when I receive a fax of a mortgage worksheet or of a boat note or of an airplane note, that's all I've got is income stream information, collateral information, payor information, the documentation, but I don't have any sense of the deal. I don't understand what the seller's trying to accomplish. I don't understand how did you come across this deal, where is it coming from. So as a result, I'm mechanistic. I mean, I can evaluate the numbers, but I can't really help you a great deal. So what you want to do is when you're working with a funding source, you're going to send them all of the basic information on those types of informational worksheets that we provided you in the training. However, over and above that, what I want you to do is prepare a cover letter. Dear Jack, enclosed is a worksheet on a note secured by a 55-footer situated here at the Marriott Marina. Real interesting situation. I happened to be talking to the marina operator the other day, and she told me about da-da-da-da-da-da-da-da. So on the basis of the conversation, I talked to the seller who had sold this boat about 2 years ago and needs to have some additional funding because they're currently trying to buy a boat that they can take on the high seas. Based on this, it looks like we can establish it as long as we can get them about $50,000 down. They don't really need the balance of the entire funding until later on. Is there anything that we could potentially do to give them a split funding program, $50,000 down now, and a certain amount in a year from now when they have to make the additional payment? Let me know what you think, look it over, and I'll call you tomorrow about 4 o'clock. All the best, cordially, Larry. In other words, give me the scenario. Give me the scenario so that I have a better understanding of how the deal is going to work. When you just send the informational worksheet alone to them, they don't have any feeling for it. They don't really understand the deal. No matter what the debt instrument that you're dealing with, whether it's factoring or it's a collateral-based instrument or even an insurance-based instrument, the more the funding source understands, not only in the informational transfer, but through the context of your cover letter and your worksheet, the better they're going to be able to serve you. And what does that mean? The more conversions that you're going to be doing. Okay? So cover letter and also the informational worksheet. The additional component of that, by the way, that I mentioned, and I'll just simply go back to, is a personal cover letter. In other words, it's not to Metropolitan. It's not to First Capital. It's not to a particular company. It's to a particular person inside that company. When you allow yourself to have that personal relationship with them, you allow yourself the opportunity to do a whole lot more business. And so from that standpoint, you want to be talking to particular people inside those companies. A graduate of ours that came from Houston, her name is Connie Mew, years ago, and I don't even think she's involved in the business any longer. Very, very successful, though. And she got involved in it and just kind of stayed in the business for quite a while. In any event, what happened is she was dealing with a particular company, and in those days, Metropolitan used contract buyers. There was a particular fellow whose name was, I better change the name. There's a particular person whose name was Bill. How's that? Whose name was Bill. And Bill had a reputation for being a little bit hard to get along with and slower than molasses as far as the deals that he would close. He would take 6 to 8 weeks to close deals for Metropolitan as an independent contract buyer. So in any event, Connie, one time I was talking to her, and I said, Connie, and she was just doing unbelievable number of deals. I mean, she was doing 10, 15 deals a month, and literally just by herself working out of her house. So I said, Connie, what are you doing? And she told me a little bit about how she's marketing and so forth. And I said, who are you using on the buying side? And she says she's using Metropolitan and she's working with Bill. And I said, wow, that surprises me. I said, because everything that I've heard about Bill so far has indicated that he is just slow as can be to work with and a royal pain. And I said, how is it? She says, I know his reputation, but he's sensational. And I said, okay, well, how is it that? She says, well, first time I ever got a deal, it was right in his buying parameters. So I got on a plane, I flew from Houston to where he was. And I met with him personally, introduced myself, got a chance to talk to him, and on the basis of that, I got that deal done, and every time now I send him deals, they're like that. I'm always on the top of the pile. Makes sense, doesn't it? I mean, it's understandable. These people are they're not funding sources. They're not walls and lights and overhead. They're people. They're people sitting at desks. They have relationships just like you do, and they develop friendships just like you do. I mean, I have to tell you, as much as I try to be even, obviously, when I get certain calls from certain people, I mean, they're the first that I'm going to call back just because of the nature of the relationship. I'll call everybody back, but sooner or later, right? But I eventually, what I certainly want to be doing is dealing with the people who are in relationship to me earlier and faster than the ones who are not. So you want to allow yourself a personal contact. So when you're dealing with a Metropolitan or you're dealing with an Associates, you're not dealing with Metropolitan. You're dealing with Fred Rui at Metropolitan, or you're dealing with at Metropolitan. You're dealing with somebody there at a particular company. When I get a call from a student who's saying, I'm having a lot of trouble with such and such a company, And I say, okay, well, tell me about it. And they tell me the situation and so forth. And I say, that's a shame. I mean, that's, for example, if it happens, that's not really the experience that I have. Who are you working with there? And they say, well, geez, I don't really remember who that guy was. And I say, well, that's your problem. I mean, that's your problem. That's not, if you don't even remember who you were working with, that's your problem. Let's allow ourselves to establish a personal relationship on the funding source side, because just like everybody else, the more you have a personal relationship, the more effective it'll be. So in terms of what you're actually doing here, what you're talking about is developing your cover letter, complete informational transfer inside of it, as well as with the informational worksheet, but it's a personal communication directed to a particular person at that company. By the way, one last thing about that, we get correspondence all the time in our office from people who are just sending it to the office. And what happens is if it's not going to a particular person, it kind of floats for a week because nobody's quite sure what to do with it, right? So somebody will read it and say, geez, that's not me. This doesn't have to do with me. I wonder if it has to do with so-and-so. So it's kind of like forward to, and then it bounces over to somebody else. And then it's like, we actually had international funding. We actually had a whole stack of documents that were being sent all over the place. We couldn't tell if it was a new deal. We couldn't tell if it was existing closing that we got. We couldn't tell if what they were trying to do was to pay off an old loan. We had no idea. So it just kind of floats and bounces from position to position. The more you have a person to deal with, the more effective it's going to be. Okay? So number one, you want to allow yourself to profile. Number two, allow yourself to produce a cover letter and a worksheet. And number three, be personal in the process of doing that. The additional comment there that you see is solutions dominated and flexibility. You want to be working with funding sources that are solutions dominated just like you. And they've got to be flexible. And you will find, as a matter of fact, I was talking to Pamela Benson-Smith, who is one of our master brokers in the Los Angeles area, and happened to do a guest lecture spot in Los Angeles, and it was about 2 weeks ago, whenever. We happened to be there. And she was saying that she was working, she said, what does she always require when she's contacting a funding source to work with for the first time? And she says she obviously needs to know what their fee structure is, and that's pretty obvious. Number two, she needs to know that they're service-oriented. And number three, she needs to know that they're flexible. Flexibility component. Allowing yourself to be, when she says service-oriented, it's really the context of what I mean when I say solutions-based, solutions-dominated. She wants to make sure that they're keen on servicing the needs of the customers or of the clients that she brings to the table. And what she talks about when she talks about flexibility is, if you're very rigorous, I mean, here's our program, this is what we've got. The more rigorous it is, the more you operate like a tailor, as I was talking about earlier. So it's kind of like we have one offer, we have a full offer on a note, or we have a full offer on the particular collateral-based instrument that you're producing. As opposed to, what are you trying to accomplish? Well, let me see what I can do. We could use a split payment schedule. We could use a split funding schedule. You know, you're trying to send your kid to college. Well, do you need all the money up front? Because if you don't need all the money up front, I can get you more money by splitting your payments. So that if you need $15,000 on August 15th of each year, I'll get you $15,000 against this mortgage. I'll buy it now, but I'll fund it by paying you $15,000 next August 15th, $15,000 the year after, $15,000 the year after that, and $15,000 the final year. And then the balance, if you want, or not, depending on what your needs are, the year after that. Well, why would I structure it that way? Because time value of money, right? If what happens is I've got to fund all now, what I'm doing is discounting to value means I discount it to today. However, if I don't have to fund it except for $15,000 a year, you're going to end up, Yvonne, getting more money in that process. So I'll offer you both ways. Get all your money right now. However, if you'd like me to fund it consistent with your daughter's college tuition, here's a way that I can do that and get you even more dollars. That's what I'm talking about by flexibility. Allowing yourself to roll as a tailor based on the needs that you as a broker are bringing to the funding source. You can only be as, if you're not producing the cash and the funding source is producing the cash, you can only be as flexible as the funding source that you're bringing to the table. Therefore, the more flexible they are, the more service-oriented you're going to be with respect to your broker. Okay? Final comment with respect to the formula. You also want to maintain what I call protocols and courtesies. Protocols and courtesies. And we're only really beginning to develop what those protocols are. Certainly there are some protocols and there are some courtesies that just make 100% common sense, but it's an important part of the formula. It's as much what I mean by professional demeanor as I also mean by these protocols. When somebody calls you up, what do? You return their call. And there's got to be a specific protocol for that. You know, we have in our office, for example, the 24-hour rule. And that is, if you get a call, you make sure that you call back before you leave that day. It's a professional protocol. There's another protocol, by the way, which says don't shop. Don't shop deals. And let me tell you a little bit about the shopping issue. The feeling about it, certainly if you have not been involved in the business to any large extent, the feeling about it is when you get a deal in or a prospective deal in with a prospect, a client, a customer, what you're tempted to want to do is to shop it to this buyer, to this buyer, to this buyer, to see which one is going to give you the better deal. The problem that you have, to a large extent, is that realize that a funding source is not making money unless they close the deal. They're not charging you an application fee, not most of the time in any event. They're not even charging your client an application fee, of course. So based on that, they don't make money unless it closes, and when they close, you make money also. They're prepared to go to the ends of the earth if they know they're the ones working with you exclusively. However, if you're going to shop the deal, and they're going to potentially do the deal or not do the deal because even if you get the deal, somebody else might get it. You're not likely to get a whole lot of service from them because the funding source just wants to know some deals are going to go, some deals are not, but if the deal goes, at least let me be the one, if I'm going to help you service, let me be the one that's going to get this deal. Because of that, you don't want to shop because it's going to restrict it. Second reason I say that to you is when you're first starting out in the business, what you tend to think is that it's a matter of price. And I will tell you, it is rarely an issue of price. It's almost always an issue of service. Now, I'm not saying that the prices are enormously discrepant. That's not what I'm talking about. But the difference between 4% and 5% and 6%, who cares? Now, yes, there's a percentage attached to that. But I can pay 4% or 4% factoring fee to one factor who is abominable, and I've got to call him every month for my advances, and I've got to call him to track down my reserves, and I have to call him to find out what's holding up my paperwork. And if the service is bad, the 4% is irrelevant. I could, on the other hand, be placing my client with somebody who's going to charge him 6%, but man, that wire transfer is there every time he needs it. Every Thursday morning at 11 o'clock, they get their wire transfer for the dollars. There's never any holdup. I never have to call him up. Yeah, 2 percentage points more, sure, but the service is right where I need it to be. It's not a question of price. You know, in the old days, in the old days of NMII, National Mortgage, we actually used to give the same quotes to 2 different people when they would come to us because they were just classified ads. And so somebody responds to a classified ad, and so we'd give the same quote on the same mortgage coming from 2 different brokers from the same city. One broker would inevitably get the deal. The other broker would never get the deal. One had to do with service and personality. The other had to do with a number. He or she was trying to shop the number. He or she was trying to make the deal based on the number. It's rarely an issue of numbers. So I say that to you because I want you to recognize professional protocol basically says don't shop the deals. Work with one particular funding source for one particular deal. Now, I call that being serially monogamous. Being serially monogamous. What I mean is, if you don't like that particular funding source, they didn't do a particularly good job with the deal, that's okay. Go back to somebody else the next time. But as to that deal, leave it alone with that particular funding source and don't shop the deal. Now, if the funding source turns it down, they say they don't want it or anything of that nature, perfectly okay. Now go to your next funding source and work with somebody else. But don't be shopping it all over town. For one thing, they're going to find out. For another thing, they're not going to have their heart in the deal. And third, chances are they're probably not going to want to work with you in the future. Okay? Professional protocol. There are several courtesies also, by the way, that I would just simply comment on. And that has to do with tone more than anything else, just the tone of your communications. And that tone just simply says, do unto others as. When you're on the phone with a funding source, there will always be sources of aggravation at any particular time, but you've got to keep in your mind all the time, you know, how would you want to be treated? Even if there's a disagreement, how would you want to be treated on the phone? I mean, I have seen brokers go absolutely berserk on the phone with a funding source. And the funding source, you know, they're cutting me out of my fee and all that kind of thing. And letters go flying all over the place. And you kind of investigate the circumstances, and it's sort of like, well, let me just ask you, is there any reason that the funding source would have known that you were even involved in the deal that got referred by this fellow over here when you never even told them in advance until the fee had been paid? And now that the fee's already been paid to a third party, now you're stepping in and telling them that you're the one that originally brought the deal to them. You know, how would you like to be treated? The way that you want to be treated, even when there's a professional disagreement, that's what you want to do to treat them at all times. And it's the same thing, I think, across the board with any aspect of these. So, professional protocols and professional courtesies. What are we trying to accomplish in this instance? What we're trying to do is to just simply make sure that you've got adequate capital at all times so that no matter what the deals are that you're bringing to the table, you always have the funding able to do that. Okay? So, all of this, how does, just like with everything else, how does it get manifested? How it gets manifested is with a funding source plan. And of course, the funding process plan allows you an opportunity to profile the funding source, and I'll just give you the specific issues there. To profile the funding source, so you have a profile for the particular funding source that you want. You've got your worksheets, which we had talked about, the contacts that are involved with that particular company, and once again, the proposed solutions which you're bringing to the table on the basis of that. Now, once again, in general terms, because you're the one who's in control of your niche, right? And since you're in control of your niche, this funding process plan actually provides across the board right from the very start the type of funding source and the specific names and contact people for the funding sources that you're going to use. In addition to that, as to the specific plan, or as to the specific prospect, just simply staple the worksheet. Fill out one of these, staple the worksheet to it, and you got it taken care of for that. Okay? Now, that's the funding source process. What do we